Joining us right now is EY Global Chairman and CEO Mark Weinberger. And Mark, it's always a pleasure to see you.
Great to see you.
Thank you so much for joining us. I know you're on your way to Beijing in a couple of weeks. What's your take on how the economy is doing there right now and its impact on the U.S.?
So we've been really bullish on China. We continue to grow double digits for the last several years in China. We're in the long term, it's going to be a great market, but it is definitely hitting some slowness due to a lot of the reforms they put in place. We're seeing more consumption-led growth as opposed to investment-led growth, and that's not as stable. Certainly, the party is more front and center now. State-owned enterprises have come back to be a major portion of the economy as opposed to this private sector, which continues to do well. So it is slowing.
This point you make about the consumption versus production-driven economy is really important because the Communist Party wants to have their hands on the lever of the economy. You can't do that when it's a consumer-driven economy. It's much harder to control than a production-driven economy.
It's a great point, and it's not as directly straight up. You can't control it, and the other element is really China is part of the issue here because they did some positive things. They came in to control some of the debt, and they tightened up some of the lending that was going on. Now they're saying maybe too much. We're going to see that open up again, and I think you're going to see they have a lot of levers that they could pull to get their economy going again by freeing that up through the state-owned enterprises. You may see some of those reforms reversed, which would be not so good.
If you bring it back to here in the U.S., you're seeing, some mixed economic data points, but really the picture is the same when we think about the global slowdown picture. Brexit is still on the table. We don't know what's going to happen with the China trade deal. We're going to probably get some noise on that over the next month or so. What are you telling your customers right now how to operate in this type of uncertain environment?
By the way, Mohamed El-Arian was here yesterday. Yeah. He said that the Eurozone will be lucky to get 1% economic growth this year. Lucky to get 1%.
Yeah, even with all this, though, it's a great question. We're seeing the U.S. grew 2.9% last year, 3.1% if you look at, fourth quarter to fourth quarter. It's projected 2.5% this year. Over the last 10 years, that's the strongest growth we've seen.
Yeah.
The global economy was reduced down from 3.7 to 3.5. So we're still seeing India growing over 7%, maybe China now closer to 6%. I think we were overly optimistic last year when we saw the G20 all growing, synchronized growth across the world. We're overly pessimistic now. You look at U.S. investment, to your point, since tax reform, we've had $3 trillion of investment last year, the fastest growth in 11 years. 3.2% earnings increase, which is putting more money in people's pockets and creating 2.6 million jobs over the last year. We're seeing inflation tame. We're seeing a very strong U.S. economy right now with a lot of opportunity.
And I'm glad you looked at the 10-year period because this is actually an historic day for the markets today. This is the 10 years from the market bottom. It took place on March 9th of 2009. It's been 10 years. Markets up 300% in this last 10 years. And you talked about what's gone on in this 10-year. It's been a real growth spurt from the bottom.
It has been, and especially, I think, with the deregulation and the tax reform. Now, I've always said this. I don't look at tax reform, never did, as a stimulus. I'm not saying that it should be used to grow the economy in a particular quarter. We have not seen the major benefits from tax reform yet.
Really? Because so it's that long of a runway, you think?
Well, the share buybacks have come first, right? And that's what everyone points to when people are concerned about. Obviously, you can argue good or bad share buybacks, but it's easy to do. It's quick. You got the money. You send it out. To change your supply chains, which is what the tax reform was aimed at, to put more marginal dollars back investment in the United States, to invest in long-term CapEx, that takes longer. That takes quarters to put that together. You need a business plan. We're working with businesses all over the world that are modeling on increased investment in the United States. That has to result in higher wages, higher capital expenditures, and then eventually increased productivity. That's going to take another year or two until we even feel that.
Are you saying, though, then, that we don't have a recession on the horizon because of that very thing? Because you've got a year or two of a long runway from this corporate tax reform.
So
that the U.S. economy is in this incredibly solid position from here for the next couple of years.
It's a great point. I am someone who believes everyone says a stimulus from tax reform is going to run off. It should never have been viewed, in my view, as a stimulus bill. The change in the dynamic of where foreign and U.S. investors will put their margin of dollar, intangible and tangible assets, has changed for the next several years. That is a positive. There's a lot of other factors that could lead to a recession, so that's a harder question to answer.
Because literally people are sitting around looking at the calendar going, you know what, we're due for a recession, which seems a little ridiculous. But
I don't like looking at it that way.
A lot of people do.
I know.
Right?
You're right. But no, you're absolutely right. Because they're saying this is long in the tooth. It's 10 years.
Right.
Yeah, but corporations are putting money to work. Their wages are increasing the last 4 months over 3%. We're just starting to see that. To your point, CapEx just starting to increase in the latter stages of 2018. So this could be, maybe there are legs.
Well, in the fourth quarter of GDP growth, as we saw 0.69% of the GDP growth was attributable to business CapEx investment. That's a huge component of growth.
Yeah, we've been saying that.
We won't see the returns on that until productivity goes up. And that's going to take another several quarters. So I think your point is spot on. I do not believe we're going to see a recession, at least not from the U.S. standpoint. Europe is a tougher situation with Brexit. You got the German situation with the change in control. You got the Italy situation. Whole other issues there.
But can things change? I mean, to Dagan's point, can things change that quickly that here we are in 2019 expecting 3%. What did Kevin Hassett was on the other day? He said 3.2% growth for 2019. Are we going to see 2 quarters of negative growth in 2020? I mean,
well, we saw 5 quarters in a row of double-digit earnings growth for businesses. We've never had a recession when we've had growth in earnings for businesses. So I don't know. A lot of things could happen. Certainly if the trade war continues to escalate, we hope it's going to de-escalate with what's going on. We're hearing today. That will help a lot.
By the way, Mark, before you go, congratulations. You are looking at now the end of an incredible run at EY come July.
Yeah, it's been a great run. It's really...
15 years?
Well, on the global board for 15 years, the CEO for the last 6.5. It's amazing. It's just to see, 100,000 more people in the last 6 years we added.
And you've been able to talk to so many companies across the world and really get insights into what's going on from the front lines being at EY.
Yeah, I'm just listening. You just want to leave a business stronger and more stable than when you got there. It's a great organization. Our business is in great shape. I feel terrific. Thank you for saying that. It's been a great run.
Mark, great to have you.
Thanks.
Thanks so much. Mark Weinberger joining us.